So this topic, corporate finance, is an extremely important topic, and the CFA goes into great detail in level 2 in corporate finance, and whatever we study here are super important topics. And this for me is the connect between, if I have to draw a diagram, you have FRA, that is financial reporting and analysis. This kind of subtly moves into corporate finance. And then you have things like equity, debt, that's fixed income. You have alts as an alternative investments. You have derivatives. So corporate finance sort of forms the link. And this is how I've mapped it in my head. Every student has his or her own way of mapping concepts. So you don't need to map it this way. But in my mind, corporate finance is what forms the link between financial reporting and analysis and the other bits and pieces. Because ultimately, when you study a balance sheet, so right, assets, liabilities, equity, right? When you study a balance sheet, this link is for corporates, right? A balance sheet is made by corporates for corporates. You're analyzing corporates, you're analyzing companies. So using this system, corporate finance is a way of describing how corporates are financed. Very simple. It's exactly what the two words are. Corporate stands for company, a body, and finance stands for how are they going to manage their money, projects, cash flow, working capital, etc. So today what we're going to do is a topic called capital budgeting, and a lot of concepts are again linked to what we've studied a little earlier, right? So if you remember, we did time value of money, right? So under time value of money, we understood the concept of discounting, etc. Now, the capital budgeting process starts off with identifying a project, right? Here you have two words again, capital and budget, correct? So capital and budget, and keep this in mind, I've written time value of money. I'll connect that very soon. Capital budget would mean that when you're doing a project that is going to last for a while, for a longer duration, you need to budget how the capital is going to be spent. I mean, you can't just throw around money however you like. Today, let's just start this project. Tomorrow, we'll shut down the project. Because you will be considering a lot of cash flows. You will be considering sunk costs and multiple other costs to actually decide whether the money that you have deserves to go into a particular project, right? So the first step is in identifying the project and ideating about the project. So this is the stage where, teams sit together, they draft different concepts. They're like, okay, if I have to take the example of Apple, when you come up with something like Apple Pencil, or when you come up with an iPhone, you sit together, you decide, oh, should we have iPhone like 4 models? Should we have 3 models? How are they going to be priced? How many people will opt for X model? How many people will opt for Y model? These decisions are to be taken by the company after this process of ideation. So this conceptual stage is extremely critical, and this is the first stage in the capital budgeting process. So this is the first stage in the capital budgeting process. Second stage is after all these concepts have been put forth by the team. Now the manager needs to decide. You can't take each and every project up. That would you would end up going over budget every single day. So you need to sit and analyze the ideas. So all the ideas you analyze, and then you need to filter this out. Filter out the bad ones. I mean, you filter out the bad ones, and then you keep the good ones, right? Right. Now, at this stage is when you teams will come in and they'll do their projection. So an analysis is a super important stage, and this is where you will determine cash flows, positive, negative. You will determine decisions, and then with a great degree of accuracy, you will decide whether the particular idea is good to go forward with, or discard, because you accept or reject a project based on this. You accept or reject a project. Accept or reject a project in the second stage. If you have accepted the project, then the third one is syncing with firm-wide budget. So what's the third step? Syncing with the firm-wide budget. That means the entire firm has a budget, and you will finally go and tell the senior managers, look, I need, if a company has $1 million, you will go and say your project needs maybe $100K, right? So you will go and match this with the firm-wide budget. And the last step in this entire process is monitoring and audit, right? Monitoring and audit, very easy step. You already know what audit means. You're checking whether things are being done as per plan, and checking whether you need to make any changes. So monitoring and audit come together, right? Audit can be a post audit. It's called a post audit. This is based on KPIs, right? Based on certain key performance indicators, you decide whether you have met expectations or not met expectations. So categories of capital budgeting. So the first category is, this is the toughest category, is when you have to launch a new product, right? Analysis is deep, right? So here you need to go into depths of analysis, and then your cash flows, in general. A new product, because you have absolutely nothing, like when you're taking a new project, the idea is that you have absolutely nothing, right? So very hard. The second one is expansion projects. Expansion means you already have product, but you want to go into a new area. Now this also complex and requires thorough analysis, but the idea here is that expansion projects, you have some idea. Let's write very little idea, right? At least, correct? Because you have launched a project in at least something. So it's just hard. It's not very hard, because when I'm launching a new project, I would be very scared. But let's say, okay, if I have to give you something in the Indian context, if I launch a project in Bangalore, let's say, even me, I started teaching in Bangalore, right? So my career started off there, and it was easy. Okay, fine. I know the market, and I could expand my range as a tutor. Learned a lot of things. But if I want to expand to Hyderabad, I won't be as scared to start off as I was with Bangalore, because when I started off, it was like, oh, what is going to happen, right? So anything new in finance, because you don't have historical data, it's considered hard, right? Then you have replacement projects, right? Now replacement projects are of two types, right? You're either taking it off and you're plugging in something completely new, right? When you want to continue business operations, right? So this one type of replacement project affects continuity, but the other type might be for something completely new, right? When do you want a new project? Because maybe you're going to get better revenue, or you're going to lower cost, right? So here this requires, let's just say, some analysis required, detailed. This is easy, right? It's a no-brainer. Not too important. There's a thing called mandatory projects. Mandatory projects are what? Like, you have to do it. I mean, obviously, mandatory projects you might have to analyze, but if it's mandatory, what does the word mean? I can't escape. I can't run away from it. It's mandatory, right? That's it. This is all you need to know. Okay, now what we're going to do is, I'm going to write some terms. Now here, accounting income is not that important. Remember, cash is king. So all your decisions in capital budgeting are made from cash flow analysis. So now you have under this something called sunk costs. And The key part is even if you do not take up the project, these are lost dollars, right? I mean, it's sunk. Whether you take the project or you don't, you will have to bear these costs. So then you have externalities. This externality, outside costs, more than thinking of it that way, externalities are of. So we'll take up this word called cannibalization. That's what the CFA uses. So what is cannibalization? Cannibal, if you remember, is the word means you consume your own species, right? Cannibalization means if I introduce a project, how much of my current revenue from another product or service will I lose? That means if I introduce, let's say I introduce a new, okay, the best example to give here is cola, right? Example is cola. So if I introduce Diet Coke and low sugar Coke or whatever, 3 varieties, obviously that Diet Coke is going to eat up into my Coke revenue, right? So when I plan, I need to consider that as well, right? So I think if, even the CFA gives the same example. Cola is one of the popular examples given in the book as well. So you can take this particular example, cola, chips, whatever you like. It's basically when one product line eats into another product line, but both are your own. Okay, so you'll have to subtract the lost sales. We'll write that in white. Subtract lost sales of other product. Why? Because I mean you're damaging the other product, right? But opportunity cost, it's basically the loss. How much, whatever you lose, you have to reduce that. The time value of the cash flows. So discounting. I'll just put the word discounting here. Financing cost plus tax. Both these rates are included in the cost, right? See, because if I'm making 20% returns, but I have to pay 15% tax, like it's a crazy thing. 15% of it goes as tax. My return is 0.85 of that, right? But whatever return I'm making, 0.85 goes. Same way, if I have to pay 7% to the shareholders, or 7% of the profit, or whatever, 7% of financing, the entire financing goes to the shareholders, that has to be reduced from the rate, right? Because again, I need to pay the debt holders who have paid me the money. So I can't just directly say ignore financing costs. And I think this is super obvious. I don't know why it's even included. Definite outcome. What are independent projects? So we'll take two projects A and B. A and B are independent means I can do both together, right? Can do both means they are independent. That means analysis or the outcome of one does not affect the other, right? If I can do both. Mutually exclusive on the other hand, if you do A, you cannot do B. Mutually exclusive me is this, right? A, if you do A, B cannot be done. Independent means A and B can be done, but whatever happens in A does not affect B. So net present value is the easiest concept to understand if you have done time value of money, right? The first lesson, what we did, give you an extremely good base to understanding what this is. So here, K is the cost of capital. Now, what rate of return do you want, right? So cost of capital has two parts. In general, cost of debt, cost of equity. You need to qualify this with one word. You need to get at least the cost of capital in general, because I want to pay off my debt holders and equity holders. I want to have enough cash flows to at least pay off my equity holders and debt holders. Okay, so net present value, as the word says, is net plus PV, right? That means present value is discounted, whereas you have net, which is positive, negative, or zero. Correct? The net present value can be positive, negative, or zero based on the discounting of cash flows. This CF0, a conventional cash flow, At time 0, you have a negative cash flow because you're paying. There's an expense to the project, right? You're probably spending on something, etc. But as and when time progresses, at T1, T2, T3, T4, T5, and so on, depending on the life of the project. So I've just taken a 5-year project. You have positive cash flows. Remember, I used another word. This is a conventional cash flow. A conventional cash flow would mean that here for all these CFs, all these represent after tax cash flows. So here you have net present value. That's it. And a conventional cash flow will have a negative cash flow in the beginning. That is a cash outflow, followed by a series of cash inflows. IRR is a concept that is linked directly to the NPV. So I said that NPV can be positive, negative, or zero, right? Very small table we'll make here. If NPV is positive, accept the project. So I just put decision. If NPV is negative, you reject the project. If NPV is zero, what do? If NPV is zero, you still reject the project because that's as good as saying there's no use doing the project, right? This is a quick table for NPV. NPV, another concept automatically follows, which is the IRR, which is the internal rate of return. The internal rate of return is the rate of return when NPV is zero. That means I will not assign a rate. I will first say NPV is zero. If NPV is zero, then I have CF0 plus CF1 divided by 1 plus R. I'll just put R over here. Plus CF2 divided by 1 plus R whole square. Let's say this is a 2-year project, a very small project. What I'll do is, let's say CF0 is minus 50 and this is plus 100 plus, let's say, 80. Divided by 1 plus R. 1 plus R whole square. This is 0, right? So when I solve this, I will get a value for R, right? This value for R is the internal rate of return, right? This value of R is the internal rate of return. Every project, now this NPV had a decision rule, right? Just as the NPV has a decision rule, you have a decision rule for IRR as well. So you have something called the hurdle rate. Hurdle rate is the threshold that you need to cross. You can think of this as a threshold. Now, if IRR is greater than the hurdle rate, then you accept the project. If IRR is less than the hurdle rate, you reject the project.